Morning. Morning. And thanks for having me back to the Investor Forum. I think I've lost track of how many times I've been back over here, but it keeps getting bigger. The breadth and depth of conversation keeps getting wider. But one thing that's always consistent over here is that the enthusiasm that you bring is always there. So thanks for bringing it. By way of introduction, I'm Gautam Samarth. A lot of familiar faces in the room today. And many of you will know me as the head of systematic investments here at M&G, and that is true. But very few will actually remember or know that the systematic investment team at M&G was actually created within the multi-asset investment team back in 2017. And we've utilized a lot of the core founding principles and valuation, disciplined valuation framework utilized for multi-asset allocation within the team dating back to the late 1990s. So as I stand over here today, I'm not here to talk to you about AI-based models. I'm here to talk to you about the underlying philosophy and framework that was utilized in developing those AI models and is continued to be used in terms of our asset allocation product in some of our most flexible, dynamic, hedge fund-based strategies, but also some of our long-only based global asset allocation products that you're familiar with, such as worldwide managed, such as global balance, such as global inflation plus, run by Craig Simpson. It's the same philosophy that underpins all of these strategies. Okay, so let's start by a little discussion about what is it that we mean by valuation. What are we asking for as investors in terms of compensation when we invest in financial assets? And I'd say the founding sort of building block, the principal building block of valuation is the risk-free rate. Think of it as the interest rate that is the opportunity cost to consumption. So it's the rate that entices consumers to defer spending into the future. It's typically set by central banks, and it fluctuates over time in order to keep aggregate demand and aggregate supply within an economy in balance. So you can start with that risk-free rate, and then you can add additional layers of risk premium on top of that, additional risk in the form of, say, duration risk by lending to the government but over a longer period of time, by adding credit risk, default risk, by lending to a corporation instead of the government. And then lastly, you can take on capital structure risk by investing in an equity where you might lose your entire investment and therefore might command a higher yield or risk premium in order to take on that risk. And as you move from left to right on this chart, you add additional layers of risk, so you should command additional compensation. How much compensation should we ask? That's the main question. And I'd argue that there's primarily three structural drivers that influence how much compensation that you want. The three structural drivers are over here. So the real interest rate environment. So what do market participants expect that real risk-free rate to look like into the future? That's the key one. The next one is inflation. So what do we expect the inflation outlook to look like going forward? And the third one has to do with the socioeconomic backdrop. So what kind of economic growth outcomes are being created by the system, and how's that economic growth being shared between the corporate sector and the labor sector? If you can understand the dynamic of these three structural drivers, you can start to get a sense of how much risk premium the market might ask for. And remember that while you do have these structural factors, there's also some emotional factors that influence risk premium market. So oftentimes, the main driver of asset pricing has nothing to do with fundamentals. You'll get these external events that come around every now and then. It's got to do much more with your recent experience. So if you take, say, the NASDAQ 100 composite of tech companies today, it trades at close to 30 times PE ratio, which is pretty rich. I think everyone talks about the valuation of tech stocks, but why is it over there? Well, certainly there's some structural underpinnings. The corporate profits delivery has been spectacular. 15% compounded per annum is what's expected from those tech companies. But I'd also argue that there's an experience whereby tech companies have delivered fantastic returns and therefore investors are willing to sort of pay up for the privilege of owning these assets. So there's an emotional aspect over there as well. But I'm going to start with the structural drivers over here and talk about how those have changed over history and influenced asset valuations. So what we're looking on this chart over here is, well, the first thing to bear in mind is that the market's preference for risk premia is not static, and the structural backdrop is not static either. So what we're looking at over here is those little dots in the corner starting in the 1990s, so early 1990s, the earnings yield on global equities in yellow, the real yield on a 30-year US Treasury bond, so deflated for inflation expectations, in green, and then the real Fed funds rate in blue over there. And you can see that entering the 90s, we went through a period whereby inflation was high, real interest rate structures were high in order to combat inflation, and profits growth through the 80s was very anemic. And so market expectations were that that environment was going to carry on. We were extrapolating the 80s experience into the 90s. Yet actually what happened was this was the start of a period where inflation declined, so from 4% to 2.5%. Corporate profits accelerated, and on the back of that, you saw this re-rating of assets where the earnings yield on global equities declined and bond yields rallied as well. So it was a very favorable backdrop where you got near double-digit returns from both bonds as well as equities. But you can also start to see then the problem that was brewing by the time the end of the decade came around, whereby the equity risk premium, or the gap between that yellow line and the green line, turned negative. And that implied an expectation that the acceleration in profits growth that we had seen through the 1990s was going to carry on into the 2000s. Of course, that's not what materialized, because what happened was you had two recessions that impeded profits growth. So first, the tech bubble bursting, and then towards the later stage of that decade, you had the global financial crisis. So profits growth was anemic in that period, and actually at the back of the GFC, you saw this behavioral-based derating of equities. So the earnings yield, or the multiple, actually went the other way for equities. And on the back of that, you had quite a sort of a lost decade, if you want to call it that, when it comes to global equity returns, primarily driven by the US over there. Bonds, on the other hand, were okay, because the other two structural drivers, real interest rates as well as inflation, actually carried on ticking down through the course of that decade. So bond returns were okay at about 6%. But this then set up an environment which was one of the most conducive ones when it comes to global asset allocation, because by the end of the decade, you had real interest rate structures that were negative. So central banks had cut interest rates in order to be more accommodative. So your cash rate was below inflation. You had bond yields that were still positive, but importantly, the global equity risk premium had blown out so significantly after the GFC that this was an attractive starting point of valuation. And then if you actually see what happened, I'm going to move to this side so I don't come in the way. Real interest rates stayed negative through much of the subsequent decade. Corporate profits actually accelerated, and that was off the back of primarily US and US tech stocks in the latter half of that decade. And so you saw a re-rating in equities, global bond yields, and US 30-year Treasury real yields declined as well. And so you saw stellar returns from both bonds as well as equities in sort of an uncorrelated fashion, and therefore global 60-40 portfolios did extremely well. Bond yields declined to negative, though, by the end of the period of time. So a lot of your bond returns came from that fall from 2% down to negative, creating a valuation problem. And that valuation problem was laid to bear as you sort of saw what happened in the aftermath of COVID. So you had the inflation flare up in the aftermath of COVID. You had central banks then increasing interest rates in order to deal with that inflation outcome. And as a result, you saw pressure on all financial assets. And so the 30-year US Treasury bond in that transition period from the early 20s to today has delivered you minus 10% per annum. So it's been a horrific journey for long-dated government bonds. Equities did okay. primarily because global profits have done really well over that period of time. So the pressure from valuation wasn't really felt in equities. But that leaves you in a world where today valuations look much more neutral. You've got a positive real return coming from bonds again. Global equity valuations look fair. And the outlook, I'd say, for real interest rates and inflation looks modest and reasonable and conducive for assets. And we'll talk about the current landscape in a bit. But I just want to talk about that framework again. So what we saw right now is how some of the structural drivers of valuation have varied over history. And structural value is important. It's an important starting point when making an assessment of investment returns. But it has a couple of challenges. The first challenge is, of course, you need to be able to predict some of those factors ex ante. So you need to be able to make a reasonable guess as to what's going to happen to real interest rate structures, to inflation, to global profits growth. And that's not an easy thing to do over multiple horizons. But even if you get that right, there's a second element whereby valuation is good into the medium term, but it tells you nothing about what's going to happen next. Because oftentimes what happens is risk premia in markets is driven by these external events that will come and drive rapid shifts. External events can take the form of pandemics, wars, or we've seen something more recently, so something like a trade war or tariffs. That can cause rapid shifts in risk premia and valuations that have nothing to do with any of the structural underpinnings that we've talked about. But you need to consider those if you're making asset allocation decisions. And so going back to those long-term valuation charts that I spoke about, I've now overlaid some of these external sort of factors that can influence asset valuations. You can see the big shifts, the big spike in yields that happened in and around the Lehman crisis, in and around the Eurozone crisis, and much more recently around COVID, the Ukraine war, and actually Liberation Day only a couple of months ago. These things can actually determine multi-asset returns over the short term in a much more meaningful fashion than any of the structural things that we've spoken about. So when you have a framework of asset allocation, yes, value is important, but it's not enough. So our way of approaching this at M&G has always been, you start with a disciplined valuation framework. And that valuation framework seeks to get a margin of safety in order to compensate you for the real interest rate structures that you think are going to persist, the inflation regime, and the profits outlook. But we then combine that valuation outlook along with an emotional assessment of the marketplace, whereby we are looking for these external events, and when they arise, we're looking to be contrarian to these external events, these behaviorally driven shifts in valuation, whereby a combination of valuation alongside a behavioral assessment of the market can be a much more fruitful asset allocation environment. It can help you be much more tactical, generating returns over the long term while protecting you against these external shocks into the short term. Now, it's a philosophy and that we've employed since the late 1990s in a very successful fashion. We've applied it across all our strategies, which I'll talk about in a little bit more in the future. Okay, so bearing that in mind then, what does the current investment landscape look like? So this chart over here, many of you will be familiar with it. My colleagues have presented it in multiple different shapes and formats over the history. What we're looking at over here is the real yields on a whole host of investable assets as they sit today. So starting with global developed market cash rates on the left-hand side in green, and then adding risk premia as we did in the earlier chart. So a bit of duration risk in developed markets in blue, emerging market bond risk in purple, some credit risk in red or coral, and then equity risk in yellow over there. So those are the real yields available to us. Now, are they good? Are they bad? In order to assess that, you have to make an assessment of to what plausible range of valuation might look like. And so this line over here, or this band over here, is our best guess as to what a plausible range for these assets might look like, taking into consideration those three structural factors I spoke about over a host of different environments. Right? So it's a reasonably wide band, but it's definitely not an exhaustive band. But these two then in combination start to give us an image of where we might see attractiveness or unattractiveness in asset valuations. So the first thing that might stand out to you is that EM assets generally look pretty attractive. So the purple lines over there, the yields are elevated relative to that range that we can speak about. And I'd say within that EM complex, you'd see SA equities, but also SA bonds look reasonably attractive to us from a valuation standpoint. There's a few other things that stand out. So cash rates in some developed market worlds still look quite unattractive, especially now that they've been brought down on the left-hand side. And then within equities, you see quite a lot of neutrally priced equity markets, but equally some, especially on the right-hand side over there, some emerging market equities look quite attractive from a valuation perspective. So Chinese equities, something that we've been invested in for the past 2 years, continue to look attractive over there. Whereas on the flip side, you can see the US equities where there's been a lot of discussion on it, and I'm happy to talk about it more, but they look unattractive from a valuation perspective, including Indian equities over there. So there's this dispersion of valuation. But as a case study, actually, I want to pick an asset that we think looks attractive that might not stand out on this chart. I've circled it over there, and that's the US 30-year Treasury bond. If you look at this chart, it looks bang in the middle of our assessment of plausible valuation. So why then do we think that this asset looks attractive? Well, this then comes back to our assessment of the current state. So what we're looking at is the development of the yield of the 30-year Treasury over here. And you can see it sits somewhere close to 5%. It was 4.8 something yesterday. But that's been in a broad range where it got to as low as 1% in the peak of the pandemic chaos. That 5%, then we have to compare it to some of those structural factors that are driving valuation. So if we first take the real interest rate structure, we think that in the current environment, a 1 to 2% compensation in terms of real interest rate is fair. And then the inflation backdrop, the past 2 decades has been somewhere around 2%. I think most participants agree that it'll be somewhat slightly higher than that. So let's say 2 to 3% inflation. But even if you take the top end of that range, so 2% real interest rate and 3% inflation, that gets you to a yield of 5%, which is where the 30-year bond trades today. Yet if you move to the middle of the range, so take 1.5% of real interest rate and 2.5% inflation, that 4% yield implies from current levels a total return of close to 20% in the 30-year bond. So now you can see that an assessment of the structural framework alongside a risk reward in terms of total return gives you very asymmetric returns in this asset. So we like it from a valuation perspective because of the asymmetry in returns that you're getting from it. And that's the structural value, great. But also, what about the behavioral side? Well, post-2022, this asset is traded in a range of 3.9% to 5%. You have the top end of that range right now, and it's happened in a pretty quick fashion. So that move from 4%, where we were in September of last year when people were talking about emergency rate cuts, to 5% today, we'd argue has been driven by much more behavioral aspects rather than anything more structural. Yes, we can talk about debt dynamics. Yes, we can talk about sustainability, but the reality is fiscal sustainability. But the reality is there's been a lot more long-end aversion because of the horrific journey it's been in terms of owning bonds. So that's why we think long-end DM duration is attractive. Okay, so we've spoken about having this framework whereby you combine structural value alongside emotional, more tactical emotional assessment. It's a framework that we've used at M&G going back to the late 1990s, and it's one that we've been using in our most tactical strategy called the episode macro strategy. It's a hedge fund-based global macro strategy dating back to the late 1990s, and as of today, we run over $5 billion in that particular strategy. It's flexible. It can invest in any asset class. It can be long or short any asset class. It's got one particular mandate, and that is to generate a positive return irrespective of the market backdrop. So whether markets are going up or down, the objective is to generate a return, and it's been able to do so. It's been able to do so because since the time it's launched, it's outperformed both global equities as well as global bonds. But more importantly, it's been able to do so with very attractive risk characteristics because of the flexibility of both the philosophy but also the structure of this strategy. It's delivered on that return objective with very low correlation to the major asset classes. So it's had a less than a 0.3 beta to equities and lower than that to bonds over the long term. And that makes it a very sort of attractive strategy when combining with your traditional building blocks of global equities and global bonds. It offers a very good diversification. And importantly, it's done so with very attractive drawdown characteristics. So when you look at the drawdown of this particular strategy, utilizing the framework we've talked about versus sort of long-only equity, long-only bond, or some sort of balanced mix of the two, it's at less than half of the drawdown. So it's been able to deliver on these return and risk objectives, again, utilizing this nimble strategy of combining valuation with the behavioral assessment of the market. And I'm sure you want to know where we're currently invested right now. And bear in mind, keep this in context of, I know there's various asset class panels today, so this gives you a sense of where we see attractiveness across various assets, but also within assets. So you can see that there's a strong preference for developed market duration or longer dated government bonds in the developed market. We also like some EM duration over there as well. We're fairly neutral on equities. In fact, we're bang in the middle, so net equity exposure in this strategy is zero. But within that, there's a strong affinity to be long some EM equities, primarily in Asia. So Chinese equities and Korea sit over there as well. And we're short the S&P 500. And yes, I know that generates controversy, but that's actually been a very attractive trade this year. And we also like some FX carry. Modest amounts, because the carry signals aren't as wide as they were historically, but carry still looks very attractive over there. Okay, so we've spoken a lot. We've spoken about how we think about valuation. We've spoken about how we seek to combine valuation signals with price action in the marketplace. So just to summarize then, I just want to say that asset valuations can have both structural components as well as behavioral components driving them over time. And the risk premia commanded by the market is not a static thing. So it can change from time to time. Valuation is a great measure. It's probably one of your best measures or indicators of returns over the medium term, but it tells you almost nothing as to what's going to happen next. And therefore, combining strategic valuation assessment alongside a much more tactical behavioral assessment of the market can be a much more fruitful environment for asset allocation. It's something that we've been doing over here at M&G, going back 25 years in a very successful fashion, and it's the core principles that underlie every asset allocation strategy that you'll be witness to, whether it's the most tactical hedge fund strategy I've talked about today, episode macro, or whether it's the ones that you have in your long-only portfolios. So with that, I will pause. I think we're up at the end of time. There is a short refreshment break, and I will be around in the refreshment break. We'll see you back in 15 minutes. Thank you very much for your time.